Welcome back to Intermediate Accounting Chapter 17. This is the second video where we're covering our post-retirement benefits. And this is a very challenging chapter, so I'm so glad that you've chosen to join me for the second video. There will be a third video as well, and that's going to be on a really tricky concept that ties into all of this pension talk as well. So make sure you watch that third one. So in this one, we're going to talk about the 5 events that might cause a change in the projected benefit obligation. Just a little recap. The PBO, the projected benefit obligation, that is the obligation that we have as a company to pay out to our employees once they retire. So we're talking about a defined benefit plan. This is where the company agrees that even after their employees retire, they're still going to pay them a portion of their paycheck. Now, this is all based on how much money they made throughout their time there, they made at the end of their time there, and it's going to be based on how many years they worked there. So that brings us to our first event that we want to consider, and that is service cost. So when I say service, I'm talking about another year of service that the employee has served the company. Every year that the employee has been there, that is more money they're entitled to once they retire. So we have to take that into consideration when we're calculating the PBO. So this represents the increase in the projected benefit obligation attributable to the employee working another year. So that's the service cost aspect. Really important to understand because we're going to talk a lot about service cost in this video and the next video, so basically the remainder of the chapter. Then we get to interest cost. This is a little different than what you might expect. So this is not interest that they're earning. This is not even interest they're paying a bank or anything. This interest that we're going to be adding to our projected benefit obligation, it has to do with the time value of money. So basically, we are getting closer and closer to having to pay out the employee, and because of that, we're going to need more and more money. We have less time to save the money. So we need to take that into consideration when we calculate what our projected benefit obligation is. So we're going to use a discounted rate. They're always going to give us a percentage, just like we've seen in all the other chapters. And we're going to multiply that times the beginning projected benefit obligation for that year. So basically last year's ending balance, this year's beginning balance, we calculate that interest based on that. So I'll show you that as well. So when a pension plan is amended, credit is often given to the employee for service rendered in prior years. This has to do with the prior service cost. So in other words, this employee's been there for 10 years and we make a change to what we think we're going to have to pay them out. Maybe the company changes the percentage that they're going to pay them, or maybe they change something else. But when that is the case, we have to make the amendment, and it has to be for the prior years as well. So here's an example. Forever Fit Gear that we've been looking at, they amend their pension formula. Their old formula was 1.5%. Remember, that's just the company choosing how much they're going to be paying out to the employee at the end of their years of service. They multiply times the number of service years times the final year's salary. Well, they revised it. They said, maybe we're not competitive enough. We need to revise this and we need to be ready to pay our employees even more. So they bump it up to 1.7%. I'm trying to make it even more than it is. So for this reason, we are going to have to go back and say, all these people that have been working for us, now we're going to have to increase that projected benefit obligation, not just going forward, but even for the years they've already worked for us. So they have upped the amount that they're going to be paying out the employees. So that's a prior service cost. So let's just look at how this prior service cost can affect our financial statements here and our projected benefit obligation. So our projected benefit obligation before they made the amendment, it was 1.5%. Our employee Maria had been working there for 10 years, and we were expecting her to make $480,000 whenever she retired. That gave us $72,000 that she would get paid out every year for the rest of her life after she retired. So we took that $72,000. Remember, this was all in the timeline in the first video. If you didn't watch the first video, you definitely should. It's really important for understanding how to calculate the projected benefit obligation. So we take the $72,000, We multiply it times, remember this is our PVA, our present value of an annuity table. And we went to how many years we expected her to work after she retired, and we used our percentage, which I believe was 5%, was our discounted rate. So we said on the day that she retires, we need $747,344 in the account ready to be able to pay her out over the next, I think it was 15 or 20 years we expected her to live. So that's in the future though. We still have time to get to that point. So what is the present value of that $747,000? So we went to the PV table. We took the 5% interest that we can earn on this money that we set aside. And we said we've got all these years to be able to earn the money. So we multiply it times the factor from the PV table, just like we did in video 1. And we said, as of right now, we should have $268,571 set aside so that whenever Maria retires, we'll have the money to be able to pay her $72,000 a year for the rest of her estimated life. Okay, that was what it was before they amended it. Then we have the amendment saying they're actually going to pay even more. It's going to be 1.7%. So we do the exact same calculations, but now they're going to be paying her $81,600 each year after she retires. We find the present value of that annuity because it's a series of payments, and that is $846,000 on the day she's expected to retire, which I believe was 2056. So then they say, well, we still have several years to raise that money, to earn that money, for it to grow. So they use the present value factor to say today we need $304,380. So the difference here from what the new amount is and what the old amount was is $35,809. That is our prior service cost. We have got to reflect that cost going forward because for the last 10 years she's been working there, we were calculating it at 1.5%. Now we need to go back and consider we need an extra almost $36,000. So that's how we calculate the prior service costs. So then let's see how that looks in getting to the projected benefit obligation at the end of the year. So it's 2036. This is when we figured out that we're going to be changing that percentage. So they started out with the projected benefit obligation of $268,571. I'm going to go back to the other slide. We see it right there, $268,571. That's what we were expecting. So this was at the end of 2035. So we're starting 2036 with that. And now they say, wait, we actually need to add that prior service cost. Now that we've bumped up the percentage, we need to add the $35,809. So now our projected benefit obligation at the beginning, when we include that prior service cost, is $304,380. Then we're going to add one more year of service because we're getting to the end of 2036. So we're going to take the 1.75 times another year, the year 2036, times the 480 she's expected to make by the time when she retires. So that gives us what we need each year during her retirement. Then we multiply it times that present value of annuity factor. It stays the same because we're still expecting her to retire the same year and live the same number of years. Then we calculate it at 1 year closer to her retirement. So that says we need to add another $32,000 almost because she's worked another year here. Then we jump to our interest cost. Remember, our interest cost is just going to be, I forgot I had all these little arrows here. So we calculated her annual retirement benefits. We discounted it to the year we expect her to retire. Then we discount it to the year 2036. So we've got another 20 years to earn it. That's how we got that number. Then we jump to our interest and we say, okay, the interest cost is going to be the beginning projected benefit obligation times that 5% interest rate. When we add all of that in, we end 2036 with a projected benefit obligation of $351,530. And this would say, okay, going forward, we've now taken into consideration the prior service costs. We've added all of that in, and going forward, we'll just keep using the 1.7%. All right, so then we want to look at the 2037. So we pulled that 351,530 from the last slide, and now we don't have to add any more prior service unless they made other changes, and they did not. So we're going to add another service year, another 1.75%. We're going to add another year times the salary we expect her to have. We're going to bring it to the present value of annuity with that 10.3797. Then we add another 0.39 to bring it to year 2037. So we add another $33,515 for one more year's worth of work. She's going to be making more. She's got another year. She's another year closer. So we need to make sure we record that. Then we have our interest costs, which again is just going to be that 5% times the beginning projected benefit obligation, which so gives us $17,577. We add all that together, and then we end 2037 with $402,622. Now, what this tells us is that's how much we should have set aside at the end of 2037. That's not always going to be the case, though, but that's what they're telling us is this is what we should have. So then that's going to lead us to the plan assets. We'll look at that in just a minute. But let's look at number 4. We've got our gain and losses. So this is going to be the decrease or the increase in our estimates of the projected benefit obligation. This is due to the periodic reevaluation of all of those uncertainties. We said there's so many uncertainties. When is this employee going to retire? How much is this employee going to make in retirement? What's going to be their final salary? How long are they going to live after retirement? So many uncertainties. So before we made any revision, we were in 2037. We were using 1.7%. She's now worked for 12 years. We expected her ending salary to be $480,000. So at this point, we're expecting to pay her out $97,920. We're going to find the present value of those payments. So this is what she needs to have at 20, or this is what we need to have set aside whenever she retires at the expected date of 2056. But then we have almost 20 years. I guess now we've got 19 years to have that money compound. So when we find the present value of that $1 million, we only need $402,000 set aside now, and then it can grow at 5% over the next 19 years. So we need to set aside just $402,000 for our dear friend Maria. But we are going to see a revision as to what we expect her to make, those uncertainties. So see here, we've still got the 1.7%. She's worked there for 12 years, but what's the difference? We now expect her to make $500,000 when she retires. So that would pay out $102,000 each year throughout retirement. So we take that $102,000 and we do the same process. It's just going to be a bigger number because we're going to be paying her out more over time. So now she's getting $500,000 instead of $480,000 is our estimate. And we are going to look at the difference between the two. That causes us to need an extra $16,557 in our projected benefit obligation. So this is due to gains or losses. So what do we do with that? Well, we're going to take the beginning projected benefit obligation for 2037. We are again just going to add in another year of service, add in another year of interest based on 5% in the beginning, the projected benefit obligation at the beginning. Then we're going to add in that loss on projected benefit obligation. The reason we're calling it a loss is it's just saying we need even more in our obligation. We are obligated to pay her even more. It's not that we actually lost any money. We just need to add more to the obligation. If we had said, wait, it looks like she's only going to make $450,000 when she retires, that would be considered a gain because we'd need even less of a projected benefit obligation. So that brings us to our ending projected benefit obligation of $419,379. Lots of calculations in this chapter. I know, it is a lot. All right, so let's see what we got next. Payment of the retirement benefits. At some point, we are going to actually be paying out our employees. So we have more employees. We don't just have Maria. We have other employees as well. So this is where we are going to take the obligation, and we are going to reduce it as we actually pay out former employees. So they're living their best life. Look at them. They're fantastic. They're obviously in Europe or somewhere. They're not in the United States because they're driving on the opposite side, but they're having a great time in their retirement because they're getting paid out by the company they used to work for. All right, so these are the things that are going to affect the projected benefit obligation as we just talked about. So this is just a summary of all those things. So we had the service cost that adds to the PBO. We have the interest cost that adds to the PBO. So does prior service cost if anything changes that affects the past as well. Gains and losses may add or subtract from that obligation, but then we can decrease the obligation for each time that we pay out our retirees. So this is just a little summary of those 5 events. Now, let's talk a little bit about plan assets. So when I say plan assets, these are the assets we set aside for the pension plan. So these are funds set aside by the company to pay out those future retirements to those employees when they retire. These assets are held in a separate trust. They're not mixed with any of the company's operating funds. They have to be held separately. The plan invests those funds. They might put them in stocks or bonds or any other kind of security in order to help them grow. That's why we see that 5%. It's growing over time, hopefully. On the balance sheet, pension plan assets are compared to the projected benefit obligation to determine if the plan is overfunded or it's underfunded. All right, so let's look at plan assets. We've got Forever Fit Gear funds its defined benefit pension plan by contributing each year's service costs. So every time a year passes, we've got more employees working for us, another year of service, plus a portion of the prior service cost. Cash of $62 million is put in the pension fund at the end of 2037. So they're contributing to it because they know that we need to keep putting money in there so that it will accumulate and be ready when our employees retire. So plan assets at the beginning of 2037 were $420 million. So they've got this money set aside in a special account. It's earning a return. The expected rate of return in this scenario is 8% on those assets. But the actual return was 9%. Now, this is going to be important in this video, but it's also going to be important in the next video. Their expected return is 8%. Their actual return is 9%. Yes, we have some good news finally. The retirement benefits of $54 million were paid out to their employees that have already retired by the end of 2037. So here's what we've got. We started with plan assets of $420 million. Now, this is not just for Maria. This is for all of their employees. They had an actual return of 9% on that 420, so they had a $38 million increase in interest. I would not hate that kind of return at all, $38 million. So they also put $62 million into it because they know they're going to have to keep contributing. And then they paid out $54 million. So we subtract the $54 million. So at the end of 2037, they had a balance of $466 million. All right, so let's see how that compares to the projected benefit obligation. So the net difference between the plan assets and the projected benefit obligation is referred to as the funded status. So in the projected benefit obligation, we had $506 million in 2037, and in the plan assets, we only had $466. So the funded status is going to be underfunded by $50 million for 2037. And we look back at 2036 and it was underfunded by $45 million. In other words, our obligation is higher than what we've actually set aside. So we either need to start getting a much higher return or we need to start setting aside more money, because otherwise when these employees retire, we won't have enough set aside for them already. So this is underfunded when there is more of an obligation than we have set aside in that account. So this would create a liability in this case. If it would have been overfunded, we had more plan assets than we had in our projected benefit obligation, we would actually have it as an asset. We've got extra money sitting in there, and hopefully it will just grow and grow, and we won't have to set as much money aside. So this is our funded status. I'm going to stop here and make sure you watch that next video because it can be really challenging to calculate the pension expense, and we're going to dive right into that.